If you joined us for the 2025 MoneyShow Masters Symposium in Sarasota, then you know what a powerful, insightful, and actionable event it was for investors. And I trust you're already putting some of the portfolio ideas you picked up there to work. If you didn't, this week's MoneyShow Money Masters podcast is dedicated to giving you a taste of what attendees heard and some new insights just for you from one of our top speakers. Among the highlights at the event, Tom Hayes of Hedge Fund Tips shared his favorite value plays in this market, emphasizing how many attractive stocks there are among the other 493. In other words, names in the S&P 500 that aren't the Mag 7. Marta Norton of Empower Investments and Liz Ann Saunders of the Schwab Center for Financial Research gave you fantastic top-down views on the markets. Marta emphasized the opportunities and the risks posed by the AI boom, while Liz Ann emphasized the value of long-term investing and why looking for other winners in 2026 could pay off. Meanwhile, Anas Al-Haji of Energy Outlook Advisors laid out a strong case for LNG as the place to be in the energy sector, pointing out strong global demand and ways to profit from the companies that transport and ship it. As for Ed Yardeni of Yardeni Research, he explained why both the S&P and gold could hit 10K by the end of the decade, an interesting thesis considering they sometimes trade in opposition to each other. And Michael Lee of Michael Lee Strategy gave you a laundry list of AI stocks for the year or two ahead, and frankly, put a powerful smackdown on the bearish arguments in that space. Now, I'm pleased to share a sit-down interview I did with Larry McDonald on site. He's founder of the Bear Traps Report, and he lays out a very convincing case for hard assets. He also explains why you should be pivoting to an inflationary investing mindset and what risks in the credit market keep him up at night. Enjoy this Money Show Money Masters podcast recorded from Sarasota. Today I'm speaking with Larry McDonald, founder of the Bear Traps Report. Larry, how are you?
Mike, good to see you, my friend. Thank you for having me. I really appreciate it.
Absolutely. I've already heard great things from the audience. They're really pleased that you're here, and your message and sort of investing in inflationary times and the benefit of hard assets. Certainly that's been a strategy that's been working. Talk a little bit about what you had to say in the keynote room.
Well, I think the biggest thing going into the new year is the leveraging with the Fed cutting rates, right? And then the fiscal spending. And then all the money that came into AI.
Yeah.
It really sets up for an inflation bounce next year. It's a midterm election. The Trump team wants to keep rates down. That's a little bit of financial repression.
Sure.
And all that means is pushing rates below inflation. Great for hard assets. Got some really good ideas. But yeah, I think it's a story of cutting rates, fiscal, and all that trillions and trillions of dollars of AI spending that gets you some phenomenal rotation out of financial assets into hard assets.
You had some great stats about Nvidia and market cap relative to sort of the juice that fuels the AI revolution. Talk about that a little bit.
Well, right now, all the natural gas equities combined in the United States are valued about $600 billion. Now, the key for Nvidia is the growth, and the key for the growth is the power. So if you're going to put 900 more data centers into the United States over the next 5 years, that's what we're told, that's the plan for Wall Street.
Sure.
That's how you get to NVIDIA's valuation. So 4 years ago today, NVIDIA was 1% of the S&P, not even 1%.
Yeah.
Today it's almost 8%, 7.5%. So the stock is assuming a lot of growth, which is fine, but in order to get that growth, you need a lot more power.
Yeah, I got you.
And so the risk reward to be long natural gas equities, coal equities versus being long in NVIDIA is spectacular. I think the natural gas equities, if what NVIDIA and Jensen say is true, Jensen, the CEO, about the fact, natural gas equities have to triple the next 3 years to achieve that artificial intelligence growth path.
Got it. And let's talk about, hard assets in general. I mean, obviously gold, silver, many of these metals have done phenomenally well in 2025. What's driving that, and what do you see happening as we roll into the new year?
Well, what we talk about in the book is it's not just currency debasement. When you hit countries over the head with sanctions and with property confiscation over 20 years, both Republicans and Democrats, you push global trading partners into a corner where those central banks have to own more gold. Now, everyone knows that, and gold's a $22 trillion marketplace, right? Market cap. Silver is still less than $2 trillion. So I think if you look at the gold-silver ratio, or the gold ratio to copper, or the gold ratio to oil, it's really telling you to lighten up on your gold. Buy some silver, buy some copper, or copper equities, and definitely buy some oil equities, because that ratio is at really crazy extremes.
Okay, so since you brought up a few of these other non-precious metals, the coppers of the world, I know lithium, I think, is something you've talked about, rare earths. I'm kind of curious as your opinion there.
Well, lithium names like ALB, Albemarle, they're up a lot. We had a really good market-friendly election in Chile.
Yep.
Great for lithium mining. If it had gone the socialist route, that would have been tough. So the stock's up a lot, ALB, but it's going a lot higher, but it's really overbought right now, some of the lithium plays. The coal names are still cheap. Core Natural Resources, really cheap. You're talking about what I'm seeing in the resource section is because the companies have been so capital disciplined. They're much lower leverage.
Okay.
Their free cash flow relative to the market cap of the stock, you've got yields of almost 15%. In other words, they produce so much free cash flow, coal companies, that especially like CNR, that it provides phenomenal risk reward. And all those data centers, coal names are really the silent artificial intelligence trade for 2026.
Okay. Let's pivot a little bit and talk about, in the paper assets world, the debt markets, credit. I mean, are you seeing things that sort of concern you there? There seem to be some tremors out there, private credit and so on. I'm curious about your thoughts.
Private credit is literally a train wreck coming at us. I sat down with, yesterday, one of the most famous credit investors in the last 20 years. He made almost $1 billion on the subprime crisis.
Okay.
He is putting on, he's short a lot of, well, he's finding ways to short private credit. And what I'll say about private credit is this: it's 1.8 trillion bucks, but in recent years, there's 250 billion of that they promise to wealth managers and financial advisors quarterly liquidity, Mike. Quarterly liquidity on an asset that it's like a mismatch.
Yeah.
The assets aren't liquid enough to produce quarterly liquidity.
Yeah.
So because of what you talked about with Tricolor and First Brands and CoreWeave bonds, there's been this shock. It's created a kind of a run to the exits from wealth management clients.
Okay.
That's going to force, in the first quarter next year, second quarter, they have to sell some of these loans. And these loans are marked at par, Mike.
Yeah.
You know, when we talk about in the book, mark to market, mark to model, and mark to myth.
Yeah.
And in private credit, a lot of those loans are marked at par, which is 100. The bonds are probably trading in the 30s. But it takes an event to force that selling.
Yeah. Okay. Another question I have to ask while we're talking about bonds, government bond market. I mean, what are your thoughts on interest rates in the sort of financial repression world? What happens as we start the new year?
Bonds have rallied quite a bit, and it's because what we talk about is, at the bear trap support, Besant's bag of tricks. Besant's bag of tricks. So he's using financial regulation like the supplemental leverage ratio to force the banks to buy more treasuries. So even though the Fed's balance sheet has come down a little bit this year, the bank's ownership of treasuries is going up.
Yeah.
And that means JP Morgan, Citi. And so, you know, I think that they're a little extended in terms of, they've come down quite a lot in yields. Next year, with inflation rebounding, we're going to have some higher yields next year.
Okay.
So we probably have a bounce in yields.
Sounds good. Final parting words of advice for somebody looking to, as we start the new year, what they should maybe be thinking about, keep in the back of their mind.
Mike, this year, for the tax loss basket, anybody that wants our basket, it's info@thebeartrapsupport.com. We've created this basket, and what makes this year so unusual is there's 32 trillion, the NASDAQ 100, 32 trillion. But you have dozens and dozens of stocks, your Chipotles of the world, your Diageos, your Targets, your all kinds of major major companies that are down 30, 40, 50%. Lululemon. And these are great brands. So think about this. It's a bull market, Mike. You can buy Lululemon and Chipotle and Target, really great American brands, 40, 50, 30% off. So I think for the tax loss basket in years where the S&P is up a lot, what people do is accountants all over the country are calling their clients and saying, sell the losers in December, buy them back in January, take the loss. That offsets some of your gains. And what happens is, it's called the January effect. A lot of these losers in the fourth quarter are going to be big, big, big winners in the first half of next year.
Got it. Well, great advice, great pointers out here. I really appreciate you taking some time out here at the Money Show. Best of luck with the new book.
Thank you.